Expats. This is an episode that James and I recorded just before the floods in Dubai. So it's a bit out of whack. It was actually recorded last month, but we felt the topic on US exit taxes and Australian expats in the United States is an important one to cover. So excuse the chronology when you go through and listen to it. It might be a bit out of sync, but we want to make sure that we got this information to you guys. So enjoy this episode, and we'll see you on the new one. Take care.
G'day expats, and welcome to another episode 113 today. And if you're tuning in via your podcast channel of choice, or perhaps you're dialing in and listening to us on YouTube and see our faces here on the left here, we've got Brett Evans, who is the Managing Director and Founder of the Atlas Wealth Group, who is currently in the Middle East, currently in the desert, in the sandpit over in Dubai, looking after the Middle East and the Africas as well as Europe. G'day, Brett. How you going?
Right, all well, thanks. All well. It's a busy time here in this neck of the woods, and for the folks on the call, if you're joining us for the first time, welcome. Joined by my colleague and mate and business partner and guru from Australia, who specialises in the Americas and Asian region. G'day, James.
Thank you, Brett. And I mean, we've got a big episode today. We want to talk about a very important tax. And I'm being a little bit selfish today. I want to drill down on the exit tax that we commonly see over in the US, but we know that a lot of countries actually have exit taxes as well. So it's actually a bit of a common theme. But before we do so, we'll get that little disclaimer out of the way, Brett, handing it over to you.
Yep, all the information we're going to pontificate and debate on today should be treated as informational and educational purposes only. Please do not construe this as personal advice. If you do need personal advice, speak to a specialist and speak to Atlas.
Absolutely, mate. And jumping into today's episode, exit taxes. We know they are everywhere. We know countries have them. Hell, Australia has an exit tax, and it depends on the kind of assets that you're actually holding before you leave Australia. And that mainly refers to deemed disposable, and it can flow into other areas depending on your different tax structures you actually have back in Australia. We see a stealth tax or exit tax. That's usually what they also refer to as a bit of a stealth tax when you leave the country. Singapore has them as well.
Yeah, you broke the news on that. Yeah, no one had talked about that until we broke the news on the Singapore tax, and then suddenly all the people who like to copy and rinse and repeat our work, they started posting about it as well. So, but yeah, that was a surprising one.
That's it, mate. It is what it is, but it's always good to be first to the punch. And yep. I mean, when we look at the US, I mean, the IRS, they are probably the most punitive taxation authority in the world. And they're sort of, I guess, a country do as I say, not as I do, especially when we consider FATCA and common reporting standards, how they can essentially know everything about you, but if you're living in the US, that's sort of the one country that doesn't get picked up amongst that sort of common reporting standards, which is a bit bizarre. But the exit tax they have over there is very punitive. And I guess it is sometimes a case where an Australian expat that's been living there for a long time becomes a green card holder. And that means they're essentially a lawful permanent resident now, similar to being in Australia and having a permanent residency visa, exact same concept. When they've been there for a minimum of 8 years and they've held that lawful permanent residency status in 8 years, that's sort of that first test, a potential first trigger as to whether you might accidentally trigger the exit tax and become what's called a covered expatriate. And this all came from what's known as the HART Act. You know, it's essentially this final tax that the US can get you on your worldwide assets. And very quickly, when we look at Aussie's assets spread around the world, your assets can, I guess, stack up very quickly because often we might have a main residence back in Australia, and we might have some Australian super, and then we'll have some savings and other pots around the world. But when we look at the test, there's essentially 3 tests. So if we've satisfied that first test, where we've been a lawful permanent resident and we've had that status in 8 out of the last 15 years, and I guess a really important one there, it's in 8, not 4. You don't need to have a full 8 years. It's just in 8. So as an example, if you got your green card on the 31st of December, well, that's in that first year, which sucks, but it's in the first year. And then obviously you've got to be mindful of your roadmap for the next 7 years as to whether you are going to hang around or commit to a long-term, I guess, of filing tax returns and being mindful of that. But that's essentially the first test. You've held that status for quite a long period. After that, there's essentially 3 tests now that you need to consider. And you only need to satisfy one of them. The first test is the net worth test. And what's strange about the net worth test is actually the main test which hasn't been indexed for a very long time. And it's this test which looks at your worldwide assets and says, okay, if your net worth is more than 2 million US dollars, then you will become a covered expatriate and you will trigger the exit tax. So that's a really important one. And that's probably the one which I guess catches up to a lot of Australians in the event they're a little bit older, they've maybe bought a property and they've held a main residence back in Australia, maybe they've bought a property in the US, they've got 401ks, their retirement accounts, they've got Australian super. So it's all these assets. It's not just your savings, it's everything that comes into it. But that's a really important one. The next test is one that has actually received indexation, which is really good. And it's actually the net tax liability test. So right now, if your average tax liability over the last 5 years has been 190,000 in each calendar year or financial year in the US, then you'll trigger that tax liability test and you become a covered expatriate. So anyone that's right now paying $180,000, $190,000 in tax to the IRS, they're on a very good wicket. They're on a large income stream. And, if we were to do some quick math in the background, you'd be usually probably on an income of maybe 500, 600,000 US dollars. But I guess bear in mind that a lot of expats, they're not just paid base salaries, especially when they're in the US. If they're working in the tech industry, they're given what we call RSUs, restricted stock units, shares. That dollar value, that adds to that, and that's where the extra tax can come from. But we need to be mindful of whether you're going to trigger the tax liability test. If you don't, and you haven't satisfied the first test, the net worth test, that's good. We're on the home stretch. The last test is the certification test. And what's remarkable about this, it's actually the most common test that Australian expats or expats in general actually fall over. And what that test states is that you're able to certify on form 8854 that you're up to date with all your US tax returns, you have no outstanding US tax liabilities, and you're also up to date with all your information returns, and you haven't satisfied the other 2 tests. So it's literally just a certification to say, yes, I haven't satisfied the other 2 tests, plus I don't have any outstanding tax returns with you, and I can leave accordingly, give back my green card, and off I go. But because often a tax return might be missed in the last 5 years, or an information return, such as an FPAR, that's actually the most common test that a lot of expats in general trip over on, which is remarkable because then it causes a very large exit tax in having you pay tax on your worldwide assets, and it opens up, I guess, what you'd call Pandora's box.
It's interesting. I know I haven't had the pleasure of working with folks in the US since I moved to the sandpit, but remember, I always used to remind them when they're moving there in their Outlook or Gmail calendar to put at the 7-year mark, just a reminder to review, because at that point you have a clear distinction to make. If you're considering moving back, that might motivate you to move back before you do that in 8 years, as opposed to, get it back into the 7-year side, because that's, I think, the biggest thing that a lot of folks we talk about. And we did a podcast article, last week as well too, which is going out this week, talking about timing of returning to Australia and that sort of stuff. That's a classic example of why timing is imperative, because if you did get over and trip over that 8-year mark, then you might have been paying a lot of tax. You might have been, satisfying one or all of those tests, and that'll trigger the exit tax, and off you go. Question for you, Dorothy Dick's question for you: if you're on an E3, and you keep rolling that E3, can you still trigger the exit tax, or do you have to be a green card or a citizen?
Good question. E3 is my favorite visa, but I know it gives my clients, a bit of burden when it comes to getting it renewed every couple of years. It is probably one of the best visas an Australian expat can be on for as long as they're happy running through the administration. I've got clients that have been on E3s for more than 20 years. They've got no intention of becoming a lawful permanent resident or a citizen. But if you've been on an E3 visa, or say an L1 visa, then you will not trigger the exit tax event. It is only going to apply to someone that has a green card or is a US citizen. And that means that that US citizen is actually giving back their passport. They're giving up their citizenship to not have to worry about the IRS anymore. Same with the green card. They're giving back their green card and wrapping up their affairs. So it doesn't apply to those that are on those typical sort of short-term visas, E3s, L1s, O1Bs, the list, H1Bs, the list goes on, to be honest. Temporary visas, you're fine. But if you are a green card holder or a US citizen, depending on your stay and the time that you've been on that status, that's going to then flow into whether you're actually going to trigger that exit tax event. When we think about the exit tax event, there's technically, and let's consider an example, hypothetically, we've got a client, they've held their green card, they've been in the US for 15 years, they've held that status, the green card status for 9 years, and now they want to give it up. So that's part one. So they go into the next tests. They've been on a really good wicket and had a very high wage. So they're going to tick the box for the average tax liability test, which means they now become what's called a covered expatriate. Covered expatriate means they are going to trigger the exit tax event. Now, underneath that layer, there's actually 4 different exit taxes. So it gets even more complex. Don't we love the IRS for you?
Oh, yeah.
And the way that the tax is paid is it looks at the different categories of assets you have. So first and foremost, specific tax deferred accounts. So that's going to be 401ks or your IRAs in the US. So as the date that you're going to be wrapping up your affairs in the US, the IRS says you are distributing all the funds out of there on paper, and therefore you'll have to pay normal marginal tax rates on that distribution, which could be a very, very large amount. The next one is deferred compensation. And I guess you could say that's a type of benefit that we can receive depending on the employer. If they max out our 401k contributions, they'll put it into other types of accounts, which is deferred compensation. Other ones will be trust distributions. And that's where it can really annoy Australians because of how Australian super can be looked at. They might say, hey, we're going to treat your super as a type of trust, which means you're going to distribute it as of the day that you're giving back that green card. And therefore, we're going to treat that as income. And then we're going to have you pay tax on it. And then the last one is essentially all your other assets, property, shares, capital gains. And what you're doing with those assets is you're doing what's called a mark-to-market election. And essentially, whatever the capital gain is on that date, you're giving the green card up. That's essentially when you're selling it. And then whenever capital gains are due, off we go. There is a very large capital gain exemption that you are allowed to apply, though, to all your worldwide assets. Previously, it was 720,000. Now it's gone up to about 870,000. So you do get to exempt the first $870,000 worth of capital gains on your worldwide portfolio, which is really handy. And that's in US dollars as well. So that can exempt a large portion of any tax you might have to pay, but it just goes to show that it can be a bit of a minefield. And that's why it's really important that if you are going to come up to this event in a couple of years' time, plan well and plan early.
Yeah, man, I think you're spot on there. And to me, it comes back to the 5 Ps we mentioned in the last episode. You need to, you just can't wing it. And we just cannot stress this enough. Unless you like giving money out unnecessarily, then go for it. James and I'll take it. But to me, I mean, he's got a wedding to pay for coming up. God, feel for the guy.
I do.
So to me, just, it's not hard to mind map out your journey. We all have an intention, whether it is to return to Australia or to not. If it's not, then don't worry about it. If it is, okay, rightio, what does it loosely look like? We're not asking for dates and days and months and weeks. We're talking, roughly in 2 years' time, 3 years' time, 4 years' time, 7 years' time, whatever the time frame looks like. And then overlay that across the top of your situation with respect to the Hard Tax Act. Build out that and say, well, look, we are considering going. We were looking at going this time. It makes sense for us to go 6 months earlier.
Yep.
That will virtually pay just depending on your assets. That tax saving will save you, probably the cost of a car or a good deposit on a house in terms of the tax.
Yeah.
So
absolutely.
Think of it that way. You work too hard to get overseas, to do well, to make money, to give it all back again.
Yep, absolutely. And I mean, that's why it is so important to give yourself time to plan for that potential repatriation event. You've really got to think, it's not just how the IRS in this instance is going to tax you, but how's the ATO going to look at these assets as well when you come back and then you resume tax residency there? Unfortunately, our tax rates, they're more severe than the US's federal tax rates. So be careful, plan ahead.
Yeah. They'll have a second chomp on you. So, mate, I think we wrap it up there. Thanks as always for giving us that info. And I'm sure the folks out there, especially if you're US based, would definitely need to know that. And folks out there, the usual deal, like, subscribe, share, rate, review. It all makes a difference to us. It helps us get the message out there, and we appreciate everyone's support. And mate, we'll catch you on the next episode.
Absolutely. Thanks for tuning in today's episode, guys. See you on the next episode, Brett. Cheers,
Thanks, guys. Take care.